Hi friends, good morning. Welcome you all. Today in this lecture we are going to discuss the importance of mutual fund. In the last lecture we have seen the different types of mutual funds and different schemes, different type of the fund where investors can invest and the features and the categories of mutual fund schemes we have discussed in the last two lectures. Today I'm going to discuss why people should invest in mutual fund, or why people attracted to this mutual fund sector recently, because of the some benefit or advantages of mutual fund. Let us discuss first one by one. First is professional management. The mutual fund collects the small amount of retail investor and invest in a bulky manner in the market, but the fund invested by professional management means the asset management company appoints a expert fund manager to invest that particular investors pool of investment into the where opportunity is there to earn more returns or build the investors wealth. So the professional management is there for the investors fund. There are several aspects to such professional management. Investing in line with the investment objectives. What are the objectives? So according to objective, fund is invested in that particular area. Investing based on adequate research. Without research, asset management company or the fund manager do not invest. So adequate research is there, which is not possible for individual, and the individual retail investors are not market experts and not a specialized professional person on that particular area. But if we invest or investor invest in mutual fund, then their fund invested according to the objective of investment and on the basis of adequate research or sufficient research of market, and again ensuring that prudent investment process are followed. So the investment process are also based on a professional touch. So the professional management is the first advantage of investor uh, who invest in mutual fund. Next is affordable portfolio diversification. So what is portfolio? Portfolio means the investment in different type of asset. Suppose you have 100 rupees, you can invest 10 rupees in shares, 10 rupees in bond, 30 rupees in real estate, 20 rupees in gold, like that. So it is called a portfolio. So the portfolio should be diversified. Diversified means you should not invest in one type of asset. So there is the risk diversification means the risk of not getting return or the risk of negative return can be minimized when we diversify our portfolio. Means the investing your pool of fund or your whole investment into different type of asset classes, so that the negative return of one asset can be compensated by other asset and the positive return of other asset. So the portfolio diversification is very important when you are going to invest. Affordable portfolio diversification means the with the small amount you cannot invest in different type of sectors. So in case of mutual fund, the fund is large and collected from small and retail investors. So fund is very large. So the fund manager or asset management company can invest small amount, so different can choose different type of assets and invest those decided percentage on that particular asset class, so that the negative return from one asset class can be compensated by other asset class. So the affordable, this cannot be affordable for individual or retail investors, so it can be possible only for mutual fund company, not for individual investor. So affordable, so in mutual fund takes the very small charges or commission to make your portfolio diversify. So with the other real retail investor, you also get, as a single or individual investor, also get the diversified portfolio. So the economies of scale of large fund can be accrued to the individual investor. So and it is in the very small commission, or the cost of affordable portfolio diversification is very small. It cannot be possible if individual want to diversify its portfolio. It requires large amount of fund to select the different asset classes to invest your fund. So this is the second benefit or advantage of mutual fund. Let us discuss next, economies of scale. You have learned in business economics also, and in many times you have heard this concept that economies of scale. What is economies of scale? Economies of scale means the some benefits gets when something, uh, the large production is there, or when uh, whatever is at the larger amount, or at a large level, so it gets some benefits. For example, if production if production expanded, then company or the firm can get some internal benefits as well as external benefits. So it we called it in economic language or terminology, that is economies of scale. So pooling of large sum of money from many investors make it possible for the mutual fund to engage professional managers for managing investment. So because of the large sum of money, the fund asset management company or that particular mutual fund scheme can appoint or can engage professional manager for managing their investment. So market expert, or he has the, or who has the knowledge of market, or have the lot of experience of market. You are getting the professional manager or economies of scale because of a mutual fund. Individual investor with small amount to invest cannot by themselves afford to engage such professional management. So individually, the fund manager cannot be appointed, and we don't have, the retail investor don't have that much experience, don't have time, no knowledge of market. So investing in mutual fund automatically brings you professional manager for managing your investment. So because of large sum of amount, so when we called it the benefit from large sum of amount, it is called in economic terms economies of scale. Look at next point is liquidity. Liquidity means how early or without losing time, if you can convert your investment into ready cash, or the cost uh, to convert your asset into cash. So these two things are important. in case of liquidity means the converting your asset or investment into cash as early as possible. Time and cost, these are two factors. If time is less to convert your investment into ready cash, and the cost of converting your asset into uh, ready cash, when these two factors are less, time is very time required is less and cost is also less, then we can say it is a liquid asset, means you can easily convert that asset into cash. So mutual fund provides you liquidity because you can in type of low open-ended fund, you can exit when you want to convert your asset into cash. So at times investor in financial market are stuck with a security for which they cannot find a buyer worse. At times they can't find the company they invested in. Such investments whose value the investor cannot easily realize in the market are technically called liquid investment, and may result in losses for the investors. But the mutual fund gives you liquidity to exit or entry into mutual fund investment. So liquidity is important because if you need uh, to convert your asset into ready cash to finance your contingency or your need, then you can easily convert into cash. Next benefit or importance of mutual fund is tax deferral. Mutual funds are not liable to pay tax on the income they earn. So, if the same income were to be earned by the investor directly, then tax may have to be paid in the same financial year. Mutual fund offer options whereby the investors can let the money grow in the scheme for several years. By selecting such options, it is possible for the investor to defer the tax liability. So you get the tax benefits when you invest in mutual fund. So that's why if you observe the CA's office, then you will find the many the taxpayers have bought or invested in mutual fund because of the tax benefit. So tax deferral benefit is also get to the mutual fund investor. Next is tax benefit means specific schemes of mutual fund like equity linked saving schemes, as we have discussed earlier, give investor the benefit of deduction of the amount subscribed up to 1,50,000 in a financial year. So from their income that is liable to tax, this reduces their taxable income and therefore the tax liability. So some schemes are formed to save your tax. So like a equity link savings scheme can offer you the tax benefits until the 1,50,000 rupees amount per year, financial year. So there are tax deferral and tax benefits of mutual funds also. Next is convenient option. The option offered under a scheme allows investor to structure their investment in line with their liquidity preference and tax position. So according to the investors objectives, there are lot of scheme offered according to their objective and investor structure. Mutual fund also provide the convenient option to invest in different type of schemes, and there is also great transaction conveniences like the ability to withdraw only part of money from the investment account and ability to invest additional amount to the account. So setting up systematic transactions, you can withdraw money whenever you require. You can invest money whenever you want to invest more amount in the mutual fund. So there are different type of schemes like a SIP, systematic investment plan is there. You can invest uh, bit by bit amount into investment schemes. So mutual fund can avail you the convenient option, different options compared to other investment classes. So next is investment comfort. Once an investment is made with a mutual fund, the mutual fund make it convenient for the investor to make further purchases with very little documents. So the documentation is very little when once you invest in mutual fund. This simplifies subsequent investment activity and gives the investment comfort to the investors. So this is the importance of mutual fund or the advantage to the investor. Next is regulatory comfort. The regulators like SEBI, Securities and Exchange Board of India, has mandated strict checks or the regulations and balances in the structure of mutual fund and their activities. Mutual fund investor benefit from such protections. So SEBI, uh, there are two regulators on the mutual fund, that is Association of Mutual Fund in India, and that is AMFI, and SEBI also, Securities and Exchange Board of India. Again, Reserve Bank of India also there whenever the fund invest in money market. So money market regulator is Reserve Bank of India. So there is a regulatory comfort. There is no risk of uh, mm, like a cheat fund or nidhis. So the mutual fund are well governed by the regulatory authority like SEBI, AMFI, and AMFI imposes a code of conduct and ethics and the fair practices in mutual fund industry. Like SEBI also promotes the fair practices and ethical the regulations and ethical practices also. So regulatory comfort is there, so no worry about the investment in the mutual fund. Next is systematic approach. Mutual fund also offer facilities that help investor to invest amount regularly through a systematic investment plan, that is SIP, or withdraw amount regularly through a systematic withdrawal plan, that is we called it SWP, or move money between different kind of schemes through a systematic transfer plan. So we can move the money from a different kind of scheme or different type of schemes. So we called it STP. So such systematic approach promote investment discipline, which is useful in long-term wealth creation and investment protection also. So systematic withdrawal plans allow the investor to structure a regular cash flow from the investment account. So uh, we can make investment systematically, and you can withdraw money with a systematic withdrawal plan also. So mutual fund investment have a systematic approach to invest in mutual funds. So this is the benefit or importance of mutual fund. Risk aversion. The individual or retail investor will find it difficult to invest in stock market or in the financial market because they don't have expert in that market, don't have the knowledge, the lack of adequate research and professional touch to their investment, the absence of fund manager. So these are the lacunas are with uh, retail investors or individual investors. These are avoided by these can be uh, avoided by the mutual fund, and uh, the risk minimized by the retail investor through mutual fund. So mutual funds minimizes the risk of individual or retail investors. Then financial inclusion. Mutual funds have important role in financial inclusion. What is financial inclusion? Financial inclusion means the people or the sections of society which are not taking the benefit of financial market. So they are not getting the benefits or advantages of financial market, such as investing in stock market, investing in the treasury bills, bonds, like that. So in the Indian economy, the traditional ways of investments are there, like bank FD and gold and other popular ways are there. But the many peoples are not uh, investing in financial markets, so they are not getting the benefit of such type of investment. So mutual funds uh, providing them the opportunity to invest in such a volatile market, or to uh, the the increasing market, or mutual fund providing them platform to invest in a financial market and accrue the benefits of financial market to these retail and individual investors. So friend, these are the next is so these were the importance of mutual fund and benefit to the investors. Now let us discuss in short the limitation of mutual fund. First is a lack of portfolio customization. Means some brokerages offer a portfolio management scheme, that is PMS, to large investors only. So in case of retail investors, there is the different condition. In a PMS, the investor has better control over what securities are bought and sold on his behalf. So large investors have a better role, so they can impact on the mutual fund schemes, where to invest and what to buy with the money collected by that particular mutual fund scheme. The investors can get a customized portfolio in case of PMS. So on the other hand, a unit holder in a mutual fund, so the investor in mutual fund called unit holder. So unit holder in mutual fund is just one of several thousand investors in a scheme. So he or she is only individual or retail investor, like other thousands of investors. So once a unit holder has bought into the scheme, investment management is left to the fund manager. So they don't have the choice to where to invest in mutual fund. So within the broad parameter of the investment objective, fund manager invest on their own. Thus, the unit holder cannot influence what securities or investment the scheme would invest into. So there is no choice where to invest and where to not, what to buy and what to sell. So these all the decisions, once retail investor invest in the scheme, fund manager takes the decision of further investment. So this is the one limitations of mutual fund. Second is choice overloaded. So there are multiple of mutual fund schemes offered by 42 mutual funds. Are there are some more mutual funds coming into market, and multiple options with those schemes, which makes it difficult for an investor to choose between them. So we have discussed earlier in the lectures, lot of schemes are there, lot of names are there, and there is a mess continuously goes on into the mind of investor, that where to invest, which scheme to purchase, or where to invest, which units, which mutual fund is better, and which scheme is better. So greater dissemination of industry information through various media and availability of professional advisor in the market helps investor handle this overload. So professional advisors are there. So here the career opportunity arises for you students, to become a professional advisor and consultant in the mutual fund. In order to overcome this choice overload, SEBI has introduced the categorization of mutual fund to ensure uniformity in characteristic of similar type of schemes launched by different mutual funds. This will help investors to evaluate the different options available before making informed decision to invest. So recently you have listened the different advertisement of mutual funds published by SEBI and government of India. So SEBI introducing different categorization of mutual fund to ensure the uniformity and introduce different scheme to investors. No control over cost. Next limitation. All the investors' money is pooled together in the same scheme. The cost incurred for managing the scheme are shared by all the unit holders in proportion to their holding of unit in the scheme. So therefore, an individual investor has no control over the cost of in the scheme. So the what a commission or which load means the cost of that particular mutual fund scheme. Uh, their individual or retail investor don't have control over it. So SEBI has, however, imposed certain limit on the expenses that can be charged to any scheme. So these limits which vary with the size of assets and the nature of the scheme. So we are going to discuss later on the cost of the scheme or the uh, details. So friends, that much in this today's lecture. If you have any queries, questions, then let me know, or text me or mail me. Write your name and roll number in the comment box after finishing or watching your video. Makes note of lecture. So thank you. See you in the next lecture.